Good morning. Welcome to Mauldin and Jenkins CPE webinar event. We're happy today to be talking to you about GASB 84 on fiduciary activities. My name is Joel Black. I'm a partner at Mauldin and Jenkins in our governmental practice. Joining me today, helping me moderate the session is James Bentz, who's also a partner in our governmental practice. This is our first time using the Zoom software externally, so hopefully it was easy for all of you to get in. We had the page posted up there for the last few minutes about kind of where to see, how to ask questions, etc. But there is a chat function where you can chat with us or the group, a question and answer function. If you want to ask questions throughout the presentations, you can type them in, or you could raise your hand and we can unmute you, and you can ask your question that way. So certainly a number of ways to interact with us on this presentation, and we hope that you enjoy the platform. You will, if you're attending this live, we're recording the session and it will be out on the internet if you'd like to hear it again, because it's so awesome. I can understand that for sure. But for those of you who are attending live, you will receive CPE, but in order to get your 1 hour CPE credit, there are a few knowledge check questions throughout the presentation. You will need to answer them. You don't necessarily have to answer them correctly, although I'm sure you will answer them correctly in listening to the presentation, but it's not about whether you answer them right or not. You just have to answer them in order to get your CPE. So with that, let's get on to the session. These are our learning objectives. In general, we hope that after sitting through this hour that you understand GASB 84 and what fiduciary activities are under the standard. In walking through how to practically apply the standard, we're going to use several implementation guide questions from the GASB that are very helpful. And then we'll get into the reporting requirements of the standard and how you report fiduciary activities. And finally, at the end, we'll talk about a couple of things for how you can go about getting ready and implementing GASB 84. So here are the effective dates. So 12/31/19, June 30, 2020, 9/30, 2020. Those are the financial statements where the standard will first have to be included. So certainly for December 31st, it's here now and upon us. If you're at June 30, you're probably in the process of your audits and getting financial statements done, et cetera, or you will be soon. If you're 9/30, you're coming up on year end, so you have a little bit of time, but I think it's good that you're here today and you're hearing about the standard, because I think, especially when we get to kind of the practical implementation steps at the end of the presentation, you'll see there's probably a lot of need to go ahead and at least consider how the standard will impact you and determine if there are things you then need to be doing in the interim to get ready for the implementation that will be kind of hard to do at the last minute once your year end is here and you're trying to close out and prepare financial statements. That is probably not the time to find out you have a new activity that you haven't reported before, but all of a sudden is coming into your reporting entity. You want to kind of know that as soon as possible. So it's great you're here. We're welcome. We're glad you're here, and let's keep going. So what is a fiduciary? This is not a definition of a fiduciary activity from the GASB. This is kind of a Googled definition, but generally when we're talking about a fiduciary, what are we talking about? And that generally means you're holding something for someone else, and that continues into the GASB standard as well. Under the GASB, there are kind of 4 paths to making a determination, and I'm going to show that better on the next slide in more of a picture. But I will interchange probably the words fiduciary activity and fiduciary fund. And when I do that, it's because they're kind of the same thing. But the GASB has broken up the activity that's included in our government financial statements essentially into 3 categories. You're either governmental activities, business type activities, or fiduciary activities. And they have now, with GASB 84, better defined when is something a fiduciary activity And therefore, if it is a fiduciary activity, how do we report it? Well, how to report it is you report it as a fiduciary fund of the government. So fiduciary activity / fiduciary fund more or less means the same thing, because that's how we're reporting our fiduciary activities. So here are the 4 paths in a little bit more of a pictorial form. You can see the first question you have to ask yourself is, are the assets held by a component unit? Yes or no? And this question we'll talk about more on the next slide, but is one that, you know, was always kind of relevant, but never really mattered. And so it wasn't anything we really paid attention to, but now it's going to matter. We always could have had fiduciary activities. Why we don't kind of currently care prior to this standard is that if you have a fiduciary component unit, you report it as a fiduciary fund. And that remains true even with the standard. If it's a component unit fiduciary activity, you report it like you would any other fiduciary fund. But whether or not something is a fiduciary activity now includes a component in this first question of, if it is a component unit, then we're going down 2 different paths than if it's not a component unit. So the 4 paths are, yes, it's a component unit that's holding the assets, and yes, it's a pension or OPEB arrangement. That leads you to path 1. Yes, it's a component unit, but no, it's not pension or OPEB, OPEB being other post-employment benefits. So yes and no, that's path 2. Going down the right side, no, it's not a component unit, but yes, it's pension or OPEB is 3, and then no and no is path 4. And those 1, 2, 3s, and 4s will show up on the slides throughout the presentation, so that you kind of at certain points know what path we're on, whether it's 1, 2, 3, or 4. But we're going to spend time talking about each of those. But just before we get to the paths, that first question, are you a component unit or not? I think it's kind of good to think about, what does it mean to be a component unit, or how do you get to be a component unit? And GASB 84 really didn't change that. It tweaked it maybe a tad, but really it didn't change that. So where we're looking for when we're answering that question, where within the standards, is GASB 14 as amended, primarily by GASB 61, but it's been amended by several standards as well. And this kind of flow chart is the decision tree for whether something is a component unit or not, using the kind of existing literature that actually comes from GASB 61. The paragraph numbers are GASB 14 paragraphs as amended. And so I'm not going to go through this whole chart, but I'm going to focus on the part that really probably is where fiduciary would be impacted, and that's those 3 boxes on the left there. So the first question is the potential component unit legally separate? Yes or no? No, then it's either part of our government or it's not, it's just outside. But if you answer yes to that, then you go down. Does the primary government appoint a voting majority of the potential component unit's board? Yes or no? If it's no, you still could be a component unit. You're probably not going to be if it's a fiduciary activity. Theoretically, you could be, so you would walk through that. But I'm going to focus on we're going to say yes to that question. If we say yes to appoint a voting majority of the board, then is there a financial benefit burden relationship, or can the primary government impose its will? With fiduciary, it's predominantly that financial benefit burden relationship. So the main questions are, for us, in thinking about a fiduciary activities and the kinds of entities we're going to be looking at in this standard, as whether it's component unit or not, is it legally separate? Do we appoint a voting majority of the board of the potential fiduciary activity? And is there a financial benefit burden relationship? And if you kind of answered yes to those 3, then it's going to be a component unit. And so path 1 was, yes, it's a component unit, and yes, it is a pension or OPEB arrangement. And so if you said yes to both of those, and then you meet one of these 4 types of arrangements, then it is a fiduciary activity and should be reported as a fiduciary fund in your financial statements. The 2 boxes there on the right are not very common. The 2 on the left are the ones that are more common. Those are, is it a pension plan that's administered through a trust that meets the criteria of GASB 67, or an OPEB plan that meets those same similar criteria from GASB 74. And these criteria that it's referencing are the criteria that, if you remember our GASB 67, 68, and GASB 74, 75 implementations on the new pension and OPEB standards, these are the criteria that allow a trust fund to be, to kind of net out from your total pension or OPEB liabilities so that you then report some kind of net pension or OPEB liability in your employer or primary government financial statements. So those criteria were, once we transfer or contribute money into the trust, is it irrevocable, meaning we can't get it back? Are the assets in those trusts restricted for their respective purposes, pension or OPEB? And are they assets legally protected from the creditors of the government? So if we met those criteria back from those standards, and we are a component unit, and it is pension or OPEB, these are going to be fiduciary activities / fiduciary funds for you and your government. And so how that kind of plays out practically in a lot of situations, I think, as I said earlier, is best kind of displayed by some implementation guide questions. And so I've got several implementation guide questions in here. IG on the slide refers to implementation guide, and they're mostly from the GASB 84 implementation guide, which was 2019-2. And so I'm not going to read all, obviously, hopefully, all of the words from each of these questions, but I've tried to bold or highlight the important sections of the question. So here we've got a pension plan. It's administered through a trust, meets criteria. The plan's governed by a 5-member board. Initial board was appointed by the officials of the primary government. However, successor pension board members are elected from the retired and active plan members. So in the end, the question is the local government financially accountable for the plan? Financial accountability is kind of like code words for, is it a component unit or not? That's component units are entities the primary government's financially accountable for. So is this a component unit? And the answer is no. And so if you remember our questions down there, it is legally separate. But when we got to a point of voting majority of the board question, we were going to answer no to that question because the successor, the kind of ongoing board members, are appointed by the plan, voted on by the plan members, retirees, active employees, and not by the primary government officials. So we are not a component unit in this scenario. We've answered no there. So we're not in path 1, but for this particular scenario, we would still move to path 3. So it's not a component unit, but yes, it's pension or OPEB. So we would end up in path 3, and we'll talk about path 3 later. So moving on, similar question, pension administered through a trust meets criteria. However, in this case, 5 of the 7 members of the pension board are appointed by the city council, and there's legislation that imposes an obligation on the city to make contributions to the plan. Should this be a component unit of the government? And the answer is yes. And so there's kind of 2 pieces to that component unit determination here of, is this a component unit? So it's legally separate, it's in a trust fund. And then it's, do we appoint a voting majority of the board? And the answer here is yes, we do appoint a voting majority of the board. We appoint 5 of those 7 members. So then we go to the final kind of component unit determination question. Is there a financial benefit burden relationship or imposition of will? And this is where GASB 84 tweaked component units a little bit, in that it says if the primary government, sponsoring government, employer government, if they have a legal obligation to make contributions to the plan, or, to me even more importantly, assumed the obligation to make contributions to the plan, they automatically meet that financial benefit burden criteria in the component unit determination. So in this scenario here, there was, yes, it's legally separate, it's in a trust. Yes, we appoint a voting majority of the pension board. And yes, we're making contributions, so we have a financial benefit burden relationship. This is a component unit. It's in a trust fund that qualifies, so this would be a fiduciary activity / fund of the government. So here, continuing on, very similar kind of scenario, except here, when we get to, this is pension or OPEB, and it meets the criteria, except in this situation, it does not have a governing board. Instead, another government, for example, the sponsoring or employer government, performs the duties that the governing board typically would perform. So they kind of amend the structure of the plan, set vesting requirements, what are the contribution policies, et cetera. They've assumed those. The question here is that other government, if it's making contributions to the plan, should it be included as a fiduciary component unit? And the answer is yes. And so if we're going down those questions again, yes, it's legally separate. Do we appoint a voting majority of the board? Technically, you might look at that and say, well, there is no board. So can we answer no to that question? And the GASB says, no, you can't do that if your governing board, i.e. the primary government's governing board, has effectively assumed the responsibilities of the board. When there is no board of that separate legal entity, then you're going to answer yes to that question. So in this scenario, in the absence of the board, typically in a pension or OPEB arrangement environment, the board of the employer government is going to have assumed that responsibility, even if they've hired a third-party administrator or something to do some of the administrative functions. They can't typically farm out the actual responsibility for the plan structure, what are the benefits that are being provided, what are the vesting requirements, all of that stuff. Typically in the absence of a board in pension or OPEB, they're assuming that obligation. So this question is very, I think, common given that situation. So again, this one would qualify as a fiduciary component unit because we've said yes to appointing voting majority of the board, and we said in our circumstances here they were making contributions. So yes, it was financial benefit burden relationship. All right, so this question, so if you were in it's a new webinar, we were excited, but Joel's droning on about pension and OPEBs and boards. I'm kind of losing interest. Perk back up, pay attention, because here's one of the key things that's important for you to know about GASB 84 that's going to cause changes in a lot of our financial statements, and that is the answer to the prior question the same no matter whether that pension or OPEB plan is a defined benefit DB plan or a defined contribution DC plan? And the answer is yes. It doesn't matter whether it's DB or DC, we would answer it the same way. And so you could have put this question in almost any of the other scenarios we did. It doesn't really matter what type of pension plan it is, DB or DC, we're going to treat them the same way or walk them through these same criteria. But I think the question of the absence of a board is going to be particularly, we're going to find that a fair amount when it comes to our defined contribution plans. I think many of our DB plans probably have some kind of board. Maybe it's not as common that the governing board has kind of taken over, assumed that responsibility. But in DC plans, I think it actually is going to be at least more common that there's no board for that DC plan. We kind of feel like we've hired some third-party administrator. They administer the accounts. We make our contributions. It goes over there. The employees are setting their own investment parameters. Somebody else is kind of cutting the checks and sending their statements to them. Somebody else is doing it out of sight, out of mind a little bit. We have not been reporting those defined contribution plans, and they might need to now come into our financial statements through this component unit determination. They are legally separate. Typically, they're in a trust fund over there. So that voting majority of the board question is going to be the key question, because especially in a defined contribution plan, I would imagine 99% of the time, if not 100, we're making contributions to the plan, i.e. defined contribution. So we're going to meet financial benefit burden. It's going to be legally separate. So that voting majority of the board question is going to be key for these defined contribution plans. And again, in the absence of a board, if you're the one, your board is setting that structure, establishing what the contribution requirements are, establishing vesting requirements, then we're going to have to answer yes to that question. So I believe a lot of defined contribution plans we previously not considered to be fiduciary funds are now going to need to be fiduciary funds. One last implementation guide question. This one actually isn't from the GASB 84 implementation guide, rather an older comprehensive implementation guide question and relates to component units in general, but I do think applies here when we're thinking about this board appointment question, which is one of the most important ones for our fiduciary determination. Are the appointments made by an appointed primary government official the same as appointments made by elected primary government officials? And the answer is yes. The GASB standard kind of says, do the primary government's officials or their appointees make the board appointment to the potential component unit? So what that means is, it doesn't matter, it doesn't have to be that your board of commissioners or city council is appointing the board members of this component unit of the pension board or whatever. It could also be the city manager, county manager, the administrator that's appointed by the county commissioner, city council. They could also be making appointments, and all of them are considered together in making that question or answering that question about who appoints a voting majority of the board. It's not going to matter whether that's in kind of your management making that appointment or your governing authority making that appointment. So the answer was yes. I didn't flip the answer, but the answer is yes, we would consider them to be the same. Oh wait, I went backwards, sorry. I did, it was all there. So to wrap up path one, example entities we need to consider, defined benefit and defined benefit pension and defined benefit OPEB plans are clearly within this realm. Oftentimes for our single employer plans, those have been included in our financial statements and likely will continue to be so, especially if they're in path one. Defined contribution plans, again, are the place where we're going to see the change. I've got a couple of examples kind of listed here. 401k plans, typically those are going to be separate, legally separate, and we're going to need to walk through this criteria. And as I said a few minutes ago, that appointing voting majority of the board question is going to be the important one, I think, on those DC plans and whether they need to come in, the 401ks. The 403B plans, as I understand them, that legally separate question actually may not be quite so easy. And we might need to get a little bit of legal help given your plan structure and how it was created as to whether those technically are legal separate trust funds in the same way that 401ks almost always are. And then one more note down at the bottom that's important for us to know relates to Section 457 deferred compensation plans. Those are in current GASB GAAP, including GASB 84, considered to not be pension or OPEB arrangements. And what that means is they don't end up coming into this fiduciary activity discussion. And for now, even when we implement GASB 84, we'll continue to follow GASB 32, which means these 457 deferred comp plans are going to be excluded from your financial statements in the same way they are now. So that's what we will do when we implement GASB 84. 457 plans will not kind of be considered to come in. But kind of as a spoiler alert, and I hate to spoil future GASB statements, but there is a project they're working on related to 457 deferred comp plans, which really came out kind of some of the implementation questions from GASB 84 and discussion that surrounded them. And what the GASB has kind of found, and what you will see when this ultimate project comes to fruition and we get a standard, is that we're going to put 457 plans into two buckets. One bucket is when the employer does not make any contribution to the 457 plan and it operates like maybe a traditional, typical deferred comp plan where the employee is just deferring some of their compensation. That's going to continue to follow GASB 32 and remain out. However, what has evolved over time is that some of these deferred comp plans, employers are making some kind of contribution to them. And so I think when this new standard comes out, that's going to be a separate bucket. Those really look and act and function more like defined contribution pension plans, and we are going to eventually treat those when you're making employer contributions into a 457 plan, like defined contribution plans. So when we implement GASB 84, we're not going to bring those in at all, but in the future, if you're making contributions to them, we're going to have to bring them back through this same consideration as to whether they need to be included as fiduciary activities as well. So with that, we get to our first knowledge check question. So example entities that you should consider under GASB 84 include all but which of the following? So do we need to consider defined benefit pension plans, defined contribution pension plans, defined benefit OPEB plans, 457 deferred comp plans? So which of those do we not need to consider? So I'll give you a second to answer. And again, you don't have to get them correct, but you should, if you want your CPE, you need to answer the questions. Oops. So James, how are answers coming here?
Guys, make sure there should be a pop-up that you're seeing. I see a couple of people are putting answers in the question and answer box in the chat window. Make sure you answer the window that popped up for the poll. And we're at about 73% right now.
I'm going to give you another couple of seconds to answer. All right, so what are we getting, James? So 91% of you deferred comp plans, excellent. That's exactly right. You guys are paying attention, I love it so much. But yes, those are the ones that, again, we're not going to think about for now because the GASB has essentially excluded them, saying they're not pension or OPEBs, but we will be thinking about them when they get to the end of their current deferred comp projects. All right, so that's path one. We'll move on to path two. And path two is, yes, it's a component unit, but no, it's not pension or OPEB. I'm going to actually not spend much time here because I don't expect there to be many, if any, that come in under this path. But you will see this again. So these characteristics here, that if we are a component unit, but not pension or OPEB, that would require you to be fiduciary, which are these three items here, if you have one of them, come up again in path four. And so I'm going to talk about them in path four because I think path four is a much more common path. These are kind of relate to one of those boxes. We will deal with this issue and have this slide come up again when we get to path four. So when we think about path two, though, where do I expect, I often get the question of what would be an example of a fiduciary component unit that's not pension or OPEB. The best one I can come up with might be like a private purpose trust, maybe like our historic cemetery trusts that we sometimes see, where maybe it does meet those component unit criteria, that trust fund does, but it's not pension or OPEB related. So something like that may come through in path two. But again, I don't expect it to be very common. And if you maybe did have something in path two, those concepts of whether it's fiduciary or not, we'll talk about when we get to path four. So let's keep going then to path three, which was no, it's not a component unit, but yes, it is pension or OPEB. So we're back to pension or OPEB again. And you'll see those four criteria there are the same four criteria from path one. The only thing that's really different between path one and path three, if we're not a component unit, then in order for it to be a fiduciary activity, we add in that first sentence that the government controls the asset of the arrangement. So it's not a component unit, but it is pension or OPEB. So if the government controls the assets and the asset is one of those four kind of buckets, same as path one, then it is a fiduciary activity. Again, the main two are those first two bullets, which is that it's administered through a trust that meets those criteria of being restricted, et cetera, irrevocably transferred. So what does control mean? So this is what the GASB has said when a government is controlling assets, if the government holds the assets in an account, in the government's name, or the government has the ability to direct the use, exchange, or employment of the assets in a manner that provides the benefits to the beneficiaries. So they're in an account that's in our name, or we have significant kind of ability to direct how the assets are deployed, even though it's fiduciary, so we're holding it for somebody else, but we're making some kind of decisions about what's happening with the assets in the interim, kind of when they get distributed, et cetera, in accordance with the plan. We have kind of, administrative control over that. So again, example entities to consider in path 3, really the same as path 1, but now we're adding in, because we're not a component unit, we're adding in that component of control. And so where I really see this in practice is, how I see it playing out is, we see with a lot of our defined benefit plans, pension or OPEB, that are single employers, it can kind of function one of two ways. The way I see most commonly in many of our clients, in particular in Georgia, maybe South Carolina, is that in the single employer plans, even if they have a separate board or whatever, the management of the government, the employer government, the finance department typically is kind of managing the pension plan. They're managing the investments, they're overseeing investment advisors, maybe the HR department is paying the benefits, et cetera. The kind of management of the government is administering the plan. That's going to be control, and that's going to qualify as control. And even if you're not a component unit, that's how those plans are going to continue to be reported in fiduciary. The one place where this may change, and I see this with a couple of our Georgia clients, I see it in Florida a fair amount, and you see it up north a lot too, when, I don't want to couch all of these this way, but maybe management or the employees, that members of the plan aren't as, have as good a relationship with management, maybe unions are involved, or it doesn't have to be that way, but for whatever reason, the plan itself has its own employees that administer the plan, and they're the ones that monitor, hire the third-party administrator, they're the ones that monitor the investment advisors, et cetera. Could be in those situations where if it's not a component unit, the government actually doesn't control those assets, and the plan itself has its own employees that do it, and those plans would actually not be included as fiduciary activities of the government. So there could be, I don't imagine it to be very common, but there could be situations where you actually have a fiduciary activity now reported for a single employer DB pension or OPEB plan that actually come out of financial statements that they were previously reported in. And so defined contribution plans are here too. I don't expect many DC plans to come in path 3. Typically, we don't control assets. If it's a DC plan that doesn't meet that component unit criteria, that's when most of them are going to come in. A DC plan isn't a component unit, then we have to control the assets. Typically, we don't control it. The third-party administrator handles that, / the employees themselves are directing their own investments, et cetera. Those really aren't controlled by the government. So I don't expect many defined contribution plans to come in on path 3. They're going to have to come in path 1. So that component unit determination is going to be key for those DC plans. So that's path 3. And so now we're on to path 4, which is kind of the final path, and the path where a lot of our maybe more traditional non-pension or OPEBs will come in or remain in our financial statements. And so in path 4, an activity is fiduciary if it meets all three of these criteria. The first one is the government controls the assets, which is that same definition of control we just talked about in path 3. So we're holding it in an account, or we have the ability to direct the use, et cetera, of the assets. So we control it, and the assets are not delivered from either the government's own source revenues, which means it's kind of revenue that we as the government created and collected. That can't become a part of a fiduciary fund. That's kind of our money, and we might be some responsibility of what we're going to do with it, but it can't be fiduciary. Fiduciary is it comes in from some other place, and by kind of nature or something else, we're holding it for somebody else, but we didn't generate the revenue. It just came to us from some other source. So the assets are not our own revenue. And then the second one is essentially it's our own grant revenue. So we have some grants coming in that aren't pass-through grants where we have no administrative involvement, but we have, generally speaking, the grants in our name, and we have some responsibility for the grant. If it's that, it can't be fiduciary. That's just our activity. So again, first criteria is we control it. Second criteria is it doesn't come from our own revenue or our own grants. And then third, it meets one of the criteria on the next slide. These are those same path 2 criteria. So it's going to be fiduciary if we control it, it's not our revenue, and we meet any of these 3 criteria. The first one in the orange is the assets are administered through a trust that's legally protected from the creditors. So this is kind of non-pension, non-OPEB trust. So these are where a lot of your private purpose trust, investment trust, those types are going to come in and be fiduciary activities. And then the second 2 criteria over there that it could meet to meet that overall third requirement are really splitting into 2 ways. So if it's not in a trust, we're going to look at it if we're holding it for the benefits of individuals, we're in the gray box there in the middle, versus if we're holding the assets for another organization or another government, then we're going to be in the blue box. And so if we're in the gray box there in the middle, we're holding it for the benefit of individuals, then it will be fiduciary if we do not have administrative involvement or direct financial involvement with those assets. And I'm going to talk about what that means on the next slide. Versus if we're in the blue bucket there and we're holding the assets for the benefit of another government or another organization, it just can't be derived. The money can't be derived from our transactions with that other government. And then it would be fiduciary. So what does direct financial or administrative involvement mean? These are examples of what that means. These aren't kind of definitions of what it has to have for it to meet that definition. These are just examples, but administrative involvement are things like we're monitoring for compliance with requirements, we're determining what the eligible expenditures are, we have ability to exercise discretion over how to allocate the assets. Direct financial involvement would be something like making a matching requirement into a fund. So again, if you go, I'm going to go backwards on us. Path 4 is we meet all these criteria. We control it. It's not our own revenue. And any one of these 3 criteria are met, which again are, it's in a trust fund for some other purpose. We're holding it for individuals, and we do not have administrative or financial involvement in it, or we're holding it for other governments, and we didn't generate it from our activity with them. All right, so we got to kind of walk through all of those criteria. But if we get through those, then, and we end up saying, yes, that's where we are, then this is a fiduciary activity and fiduciary fund of the government. So the example activities to consider here, funds held by courts, funds held by tax commissioners, sheriff, school/student activity funds. Those are things that are typically reported as agency funds now in our current fiduciary fund activity. And this path 4 is where we're going to have to kind of reconsider those current agency funds and make sure they continue to meet the fiduciary criteria. And that's where I think a lot of these kind of are going to continue to meet that criteria. But let's talk about a few implementation guide questions to kind of get at a few of these different Path 4 items. Or maybe some of these are general questions that kind of come up that I think might be kind of common. So this first one is the contractor hires the city and places a cash deposit with the city for an assurance that the project will be completed, and the contractor is building a new building for the city. So should that deposit that's being held be considered to be fiduciary? And the answer here is no. The deposit kind of comes from an exchange transaction between the contractor and the city, and that transaction is benefiting the city. They're building the building for the city, so that cash isn't a fiduciary activity. That's our own activity as the city and would just be included in the whatever fund kind of is holding the deposit, but it wouldn't be a fiduciary activity. And so now we have a series of questions which help illustrate this Path 4 criteria, but mainly relate to our school districts. And we have a number of school districts in attendance today, so I will spend some time on these, but you can apply these kind of concepts to any, I guess, organization you have. These all deal with student activity / club kind of funds. And so this first one is, we've got a chess club. It's not legally separate. It's not a legally separate entity. It's not legally separate from the high school. They fundraise and get their activities. It's held in a separate bank account in the school's name. And the resources. So the question here doesn't start out with, is this a fiduciary activity? The question actually starting out when we're in those buckets and we have to make this determination of, are we holding it for individuals? Are we holding it for an other organization or other government? Which of those buckets do we look at for a chess club like this that is not legally separate? Do they benefit individuals or do they benefit organizations? And the GASB has said in this scenario, because the club is not legally separate from the primary government, it is not itself an institution. So we're not in that bucket, but rather the school district is really holding it for the benefit of all the individuals that make up and participate in the club. So we should evaluate it in the bucket of, are we holding this as if we are holding this for individuals and not for another organization? So that administrative criteria, et cetera, kind of comes up. And so let's continue down that path. Another student club could still be the chess club. It's not legally separate from the school district, raising money through fundraising events, depositing it into an account that's controlled by the school district. And in this scenario, the student club president, along with the members of the club, establish how the resources are spent and approve the disbursements. In this scenario, does the school district have administrative involvement? And the answer is no. So this would end up being a fiduciary activity of the school district. So in this scenario, if we're walking down Path 4, it's not a component unit, it's not pension or OPEB. So we got to back to our kind of main 3 criteria of, do we control the assets? We're going to answer yes to that here because the account is in the school district's name. Is it not our own revenue? And the answer is no, it's not our revenue. The club itself is going out and fundraising. That's how this money is coming in. That's not school district generated revenue. The club kind of generates the revenue. So it's not our own revenue. So then the final thing we had to clear to have this be a fiduciary activity were those 3 buckets. It's not in a trust fund. And so then it was, is it individuals or organizations? Based on that last implementation guide question, we're holding it for the benefits of individuals. So for it to be fiduciary, we cannot, as the school district, have administrative or financial involvement. And we've said here, the students kind of run their own club, they make their own decisions. So we do not, as a school district, have administrative involvement. This student club account would continue to be included as a fiduciary activity of the school district and fiduciary fund. So here, I'm going to throw a knowledge check question at you, but let's talk about the question for a second. It's a similar question in that we've got student clubs, they're not legally separate from the school district, and they're being held by in an account that is the school district's. But the main difference between the last question and this question is the disbursements, instead of being approved and deciding on what to spend your money on, is being performed by the faculty advisor. You know, we're at the middle school chess club, and we're not allowing the students to, or maybe the elementary school chess club, we're not allowing the students to decide where all their money is, because we actually want chessboards paid for with club funds and not just candy, right? So we've let the faculty advisor approve, reject, modify. They're the ones making decisions about where the club fund-raised funds are going to be spent. So in this case, does the school district have administrative involvement under GASB 84? So what do you guys think? Yes, they have administrative involvement, or no, they don't, or it depends?
Hey, Joel.
Yeah.
We do have one question asking on trying to just clarify the difference, which the answer to this probably will, but clarifying the difference between where the administrative involvement in this question versus the previous implementation question is distinctly made.
Okay. So the distinction is, in the previous question, the students themselves were making the decisions. They went out, they raised money. It's a high school chess club. They went out and they raised money. And yes, they may have a faculty advisor because policy requires them to, but the students are really making the decisions. They got their money that's been fundraised. They make the decisions about how to spend the chess club dollars. They say, well, we want more chessboards, or we want to travel to this tournament, or whatever. They make and approve those decisions. And the check is probably, you know, approved by the principal in that scenario, in most scenarios, because typically the students can't sign the checks because the account is still in the school district's name. But if the principal is really just making sure, hey, they're not buying something crazy or illegal, maybe and buying a bunch of beer with the chess club money, you know, there's kind of more a formality approval for compliance, not so much a substantive approval that's, hey, I don't think you should go attend that tournament. I think you need to spend your money on more chessboards. If the principal isn't doing that and the students are really driving what the money is spent on, that was the last question. That means the school district doesn't have administrative involvement and can therefore, that remains a fiduciary. In this scenario, we've said, no, we don't really trust the students that much. We've got the faculty advisor making the decisions about how the fundraised money is spent. So the difference and distinction is, in one, the students substantively made the decisions about how to spend the money. In this question, the faculty advisor is making the decisions about how to spend the money. So what do we have? What are our answers here, James? So 81% said yes, the school district has financial involvement. And then we got another 13% with it depends. The answer was meant to be yes. I think you could always choose it depends with these questions, because facts and circumstances can be weird and there's subjectivity at times. But generally speaking, the answer is yes, and that is what the GASB said in this scenario, is that yes, the school district does have administrative involvement. So in this scenario, we've said, no, it's not a component unit, and no, it's not a pension or OPEB. In Path 4, the government does control them. It's in an account in the government's name. It's not our own source revenues, so we're good so far because this fundraised money. Then we're in that third bucket that we had to meet one of those criteria. It's not in a trust fund, so we didn't meet that. It's not being held for another organization, so we didn't meet that. And so we're holding it for the individuals. Does the government not have administrative involvement? We can't answer that yes, the government does have administrative involvement. So this can't be a fiduciary activity, which means this activity, which probably used to be recorded in the agency funds and the fiduciary funds, can no longer be fiduciary activity because the school district is administratively involved, and now just needs to be general government activity of the school district. So it rolls into the general fund, it rolls into a special revenue fund if it's committed or whatever. It has to just go into the other funds, governmental funds of the primary government. So that is likely to be a change for many of these school districts for some, if not maybe all of these funds that used to be student activity funds out in the agency funds. At least some of them are likely to need to come into your general government activity. So here, getting through these last couple real quick, essentially here the school district has a policy that relates to administrative disbursement of funds. Can that automatically dictate all of them move? It's possible. I would caution you to, how that kind of subjective compliance approvals versus a substantive approval. I hate to blanketly say all these funds need to move, the student activity funds need to move, but it is possible that your policy, just by the way it's written, could automatically make all of these you administratively involved in all student activity funds, and therefore they all move out of fiduciary and into your typical activity. This one relates to like a separate legal touchdown club. So we've got separate legal standing. They're making their own decisions, et cetera. Do these all of a sudden need to come in? And the answer is no. That was, if you read through that criteria, it's pretty clear. We didn't meet the kind of component unit determination. We're not holding it. We didn't meet the fiduciary activity. This is just, it used to be separate. It's still separate. If it's not a component unit, then they're not coming into our financial statements. They probably weren't there before. So the final implementation guide question gets out of the school district. So if you were like, okay, he's been talking about school districts for a long time, kind of checked out, we can check back in. This is more a county, city kind of activity. So in this case, the county government imposes an annual license fee under the county's business license function, $1,500. The county has entered into a revenue sharing agreement with the state that results in the county keeping $1,350 of the $1,500, and the remaining $150 is held in an account by the county until it's then remitted to the state, maybe say monthly, the next month or whatever. Should that account that's holding the state portion of these fees be considered own source revenue of the county? And how does that play into the fiduciary, activity determination? And the answer to the question is yes, this is the county's own source revenues, which means it cannot be fiduciary activities. So if we were in path 4 in this scenario, we said, are we controlling the account? Yes, we are controlling the account. It's an account in our name. Is it from our own source revenues? And the answer is yes, it's from our own source revenues. So the question was, is it not our revenue? We can't answer that positively. It is our revenue, our own source revenue, because the license fee was by statute a county generated license. It is all the counties, the whole 1,500 is the county's revenue. This can't be, that account we're holding for the state can't be fiduciary. It will just be a due to other governments, due to the state government liability in the fund that collected that money. So I think about this kind of like the SPLOST revenue for the cities. A lot of cities have intergovernmental agreements with the counties, and the county collects the SPLOST revenue. The SPLOST revenue is a county generated by referendum revenue that they've entered into a contract to share with the cities. So that account that the county holds that money in until it then remits it to the cities, is that fiduciary? That's similar to this question. The answer is no. That's the county's own source revenues. So it's going to be a due to the cities in the SPLOST fund, but shouldn't be fiduciary. So that ends the path. So those are the kind of ways in which you get to, is something a fiduciary activity? And if you got to that point and you said, yes, then we meet one of these criteria on this path and it is a fiduciary activity, then what do we do with it? What we do with it is report them as fiduciary funds, doesn't matter which path they came in on, we'll report them all the same in fiduciary funds. And we're going to have, the same way we kind of do now, we're going to have 4 columns for the 4 different types of fiduciary funds, or you could have 4 columns, up to 4 columns, if you had one of these types. And so just like we do now, we're not going to put individual fiduciary funds in our basic financials. We're going to kind of consolidate them all into one of the 4 types of fiduciary funds, and each of those fiduciary fund types that we have will then have its own column in the basic financial statements. Those fiduciary 4 types are, the first 3 should sound very familiar because they're what we currently have: pension/OPEB, other post-employment benefit trust funds, or the second one, investment trust funds, the third one, private purpose trust funds. We have those now. Those definitions were kind of tweaked under the current standards, but really for the most part didn't change. Functionally, you will continue to have them. If you have them now, that's what they will continue to be. The final one is where we have a little bit of a change. What we used to call agency funds now is really considered to be custodial funds. We're going to call it something different. In the grand scheme of things, is there really that big a difference? No, but there is kind of a fundamental kind of difference in how we're defining fiduciary that made the GASB want to change it. It's not so much an agent, but we're holding these custodially, so we're calling them custodial funds. And so you would have kind of that 4th column in your financial statements. And so then each of those columns, if you have them, would have to have in the basic financial statements a statement of fiduciary net position, like a balance sheet, and a statement of changes in fiduciary net position, like an income statement. And this, you'll notice, is different for those custodial funds, which used to be agency funds. Previously, the agency funds had a balance sheet, but never had to have an income statement. They will need to have an income statement now. An even bigger change than that, if you look at that bullet underneath statement of fiduciary net position, how liabilities are created for everything except pension or OPEB funds is different under this standard. And the standard says that a liability to the beneficiaries should be recognized when an event has occurred that compels the government to disperse fiduciary resources. So what the heck does that mean? I think this question really helps us get at that. So in this question from the implementation guide, we've got a youth soccer program run in the summer. Registration is fee, but each participant is encouraged to provide some kind of resources to a uniforms and equipment fund. Then the uniforms and equipment are acquired by the volunteer coaches who are not employees of the city. And the city has determined that the resources meet GASB 84 criteria and are accounted for in a custodial fund. So we've gone through and we said, okay, this money that we've collected at the time of registration to be spent on uniforms and equipment, it meets the GASB 84 criteria. It is a fiduciary fund. So we've kind of gotten all through all that. So the question here is, should the city recognize a liability in the custodial funds for those expected purchases as the resources are received at registration? And the answer is no. Liabilities should be recognized when those uniforms and equipment are acquired by the coaches. What that end result means is a custodial fund can have net position, can have equity. That's never been the case with our agency funds. Our agency funds were always assets equal liabilities. There is no fund equity. That won't be necessarily the case under GASB 84. So again, back to that criteria, I'm going to go back one slide. When an event has occurred that compels the government to disperse the resources is the criteria. So if I'm in the tax commissioner's fund, there is nothing else that the city governments, the tax commissioner at the county is collecting all the property taxes, and they collect it for the county, the school district, and the cities. The school district nor the cities have nothing else to do to require the tax commissioner to disperse their portions of the property taxes to them. So immediately upon collection, the tax commissioner is compelled to disperse those resources to the school district and the cities. So those would be liabilities. So in all likelihood, the tax commissioner's balance sheet is still going to continue to have assets equal liabilities. It just doesn't automatically have to be so in the same way it has been in the past, as evidenced by maybe this soccer equipment fund collection that we just went through. One other kind of important point to note, and if you're a standalone business type activity, like a standalone water authority or something like that, and you've been saying, why am I here? Why am I here for the last 50 minutes? This is why you're here. This is a change for you guys. It was kind of a hole and gap, if you will, previously, that under GASB 34, standalone business type activities were only required to report their standalone business activities as a balance sheet, income statement, cash flow statement. And so there was kind of this loophole that those standalone BTAs may have fiduciary activities, most importantly, a single employer defined benefit pension or OPEB fund, trust fund, that probably should have always been a fiduciary fund, but because of this kind of loophole never was necessarily required to be included. We don't have that loophole anymore. So if you're a standalone BTA, GASB 84 specifically says, if you've got an activity that meets these fiduciary activity requirements, you need to report it, and you will report it in a separate fiduciary statement, balance sheet, fiduciary net position changes statement or income statement behind the BTA typical statements you're used to presenting, your balance sheet, statement of net position, statement of changes in net position, cash flow statement. You'll now have to add in those fiduciary statements behind there, whereas you've never kind of been required because of this loophole to do so in the past. So again, that's going to be a change potentially for you standalone BTAs. All right, James, how about our third and final knowledge check? Here is a custodial fund should report a liability equal to A, amounts that are due and payable, B, an amount that's equal to the fund assets, C, amounts expected to be liquidated with available expendable resources, or D, amounts due when an event occurs that compels the government to disperse the resources. So I'll give you guys just a little bit of time to answer this final question.
And Joel, while they're answering this, we did have one question looking for clarity on when monies are held by a court due to court order, only to be distributed at the time of another court order, that those would still continue to be reported as the custodial funds.
I think facts and circumstances will dictate that. There was an implementation guide question on that particular issue in the exposure draft of the implementation guide, and the GASB took it out. I think they felt like they couldn't, they were kind of indicating guidance when a lot of laws might be different in unique circumstances, and so they didn't want people to automatically kind of revert to their guidance when the laws in your particular jurisdiction should dictate whether or not that is the case and those can remain in a custodial fund or not. But generally speaking, given your particular laws, the idea is that if you've confiscated funds and you're holding them in an account until a point in time in which the judge has to make a ruling about what happens, whether the defendant is guilty or innocent. If they're innocent, the money kind of goes back to them. It's their money that was confiscated and they weren't guilty of anything. That period of time until the judge makes the ruling, the idea is it probably meets the fiduciary activity requirements and should be in a fiduciary fund. But again, depending upon your laws and your jurisdiction, it may not have to be that way, but I would suspect a lot of them will be. And then when the judge makes the ruling, the cash either reverts back, it's no longer there for you, or they're guilty, and then the confiscated assets kind of go on, and now they become government revenues, and should be distributed the way they should be distributed. But in that intervening time, they would probably be fiduciary activities, but we'll see. All right, James, how's this question looking? As we're past our hour, so I want to get people out. So we got most of you said that final one, D, and some of those others certainly kind of sound. B is not correct. A and C kind of sound like that could be the right answer. Those tend to be kind of governmental fund definitions. Those might still play into your decision a little bit, but the criteria within the standard now is D when it relates to custodial funds. And that's that whole concept we talked about with soccer and our tax commissioner example. We're only going to report a liability for custodial funds as we're holding that cash when an event occurs that compels the government to disperse the resources. Then we're going to accrue a liability as a custodial fund. All right, so let's wrap up here. I know we're over time, but only a couple more slides. So our implementation plan. So, just a few suggestions. Inventory your possible fiduciaries. Start with what you currently have, but also need to consider items you currently don't report as fiduciary, but might come into these standards. Primarily, I'm thinking about your employee benefit plans and your defined contribution plans, or if you're a standalone BTA, maybe defined benefit plans. So think about things that you don't report as fiduciary and whether they meet some of the things we've just talked about, but look at all the ones you currently have. Gather information about that inventory, make in particular your component unit determinations. We have not really thought through that component unit determination in many of our fiduciary determinations up to now and included with current GAAP. So you're going to have to make those, and that's going to require getting, bylaws, how are officials of a defined contribution plan appointed? How's the governing authority of it appointed? What is the governing authority for the defined contribution plan? Gathering that information is going to take time. So then you make your decision based on all that information you gather for your full inventory. And then once you kind of made your decisions for activities that you previously didn't consider to be governmental, they were previously fiduciary, but now move into governmental, like our student activity funds. Consider whether budgets are needed. We're already maybe past budget time for the fiscal year we're implementing GASB 84. But if you need a budget because they're in a special revenue fund or whatever, then think about that now and figure out what you need to do. And for activities that previously were not reported in our financial statements at all, but now are going to be fiduciary funds, how are we going to accumulate, and then how are we as the auditors going to audit the information to have a balance sheet and income statement for these activities? In particular, I'm thinking about our defined contribution plans that have likely never been audited. We're not used to gathering that information. How are we going to get it? Where are we getting it from? How do we know it's accurate, complete? And then how are we as the auditors going to audit it? So again, and how's the custodial funds going to have an income statement where it's never had one in the past? All of these are just things you should go ahead and start thinking about now as before you get too late in your year and the standard is required to be implemented. So again, it's effective 12/31/19, June 30, 2020, 9/30/2020. So it's closer than you think. So I really appreciate everybody's participation. We're over time, so I think we've answered questions throughout. But if you do have questions that you didn't pose or you didn't answer, my email is there on the screen. Happy to answer. Any of your Mauldin and Jenkins people are happy to answer your questions on the subject, but you can certainly email me and ask questions if we weren't able to get to them in this presentation. And with that, thank you so much for attending. We appreciate it. We hope you enjoyed it, and I look forward to talking to you next time.